hopefully at the right time, I will absolutely sell my metals. Yeah, I said it, and I'll say it again. I'm absolutely going to sell my gold and silver. Right about now, I'm sure half of my stackers out there are shaking their head saying, nope, nope, not at all, no way. Now, listen, just because I'm going to sell, that doesn't mean I'll be getting out of silver and gold completely. It's kind of like West Side Story. When you're a jet, or should I say, when you're a stacker all the way, from your first coin purchase to your last dying day. While that is true, and my commitment to precious metals is unwavering, that also doesn't mean I need to ride metals down during a bear cycle. I'll explain. So let's talk about it. Market cycles, tops and bottoms are tricky. They can be hard to recognize and unpredictable. But if you understand the 5 stages of the investment cycle, you'll be better equipped to diagnose, identify, and even more importantly, profit from market tops and bottoms. Let's pretend we could jump into Doc Brown's DeLorean and travel back to August of 2011, when gold was over $2,200. Wouldn't it have been nice to know that it was time to sell? I mean, you could have sold your gold and repurchased it at $1,250 in 2015. I mean, you could have almost doubled your holding right there, right then. Perfect for another run up in prices. So, what's my point? When I feel like the market is topping, I will move out of metals into other tangible assets like real estate or business, or maybe even other metals that might be out of favor and ready for growth. For example, at the start of a bear market, metals like platinum and palladium lead the charge, while at the end, silver tends to bring it home. So why should we take advantage of that? I just don't see the value of letting my metals sit in my secret hiding spaces, losing value. So if we think about the 5 stages of a bubble developed by economist Hyman Minsky to see how we can use that information to our benefit, I think there's something interesting there. If you're familiar with this model, then you know all about the tulip mania in the 1600s. What they discovered was there were 5 stages to a bubble. First stage is displacement or excitement. This is the stage where people fall in love with the product or the item. It's also very often a time where there are major changes in the economy. This is the time where the smart money tends to enter the market. And then you start to experience the second stage, which is a boom. Prices, rise slowly at first, then they start to gain some more momentum, and more people hear about the market and they start to enter the market, which actually starts to really set a stage for the explosive growth that's to come. FOMO starts at its early stages, but again, the smart investors have been in way before all of this. So then when we get to stage 3 and the euphoria starts to really kick in, this is kind of the last jolt of energy that is needed for the investment to truly take off. And so this last jolt of energy and prices comes from new investors and people just kind of almost being irrational about how they throw caution in the wind and just purchase it regardless of the price or the valuation. The fundamentals, the evaluations have reached a ridiculous level, and smart investors, smart money, they start to get a sense that it's time to exit stage left. And they prepare themselves, and they understand that there's this, what many people call the greater fool theory. The idea that no matter how high a price goes, there's always someone out there that's willing to pay more. And it plays out in every investment cycle that we see. Because people have that FOMO. They want to get rich quickly, and so they jump in. And just as they're jumping in, smart money starts leaving. And then that's when you get to the fourth stage, which is the profit taking. And so seeing the fools rush in and heeding the warnings, smart money leaves. And as the quote goes, a fool flatters himself. A wise man flatters the fool. And that's exactly what the smart money does. Recognizing the warning signs of the inevitable bubble about to burst, smart money starts selling their positions and taking profits. Rather than trying to get every bit of profit and trying to time it and get the market at the top, they're comfortable with the fact that they got in early and they're going to leave a little early. Understanding that it's better to leave a little bit early than too late. The fifth stage is panic. Knowing the fragility of the bubble and the hysteria that's been created, smart money has left the scene a long time ago. But people keep pushing in and keep trying to drive that asset higher and higher. And ultimately, it starts to collapse. It starts to fall apart. And the blood starts to flow in the streets, as they say. And we all know what happens from there. And so one of the big differences between smart money and the average investor is that smart money always knows the importance of taking profits before the panic sets in. They always seem to leave the general public holding the bag because they can see the stages. They can understand what the market conditions and how things have changed. And that's essential for us as investors. And so I share these 5 stages of the bubble with you as a way to introduce a concept that can help you diagnose where we are at any particular time. And if you can see it coming, you can prepare for it. And so as the regular average investor is experiencing FOMO, they end up holding the bag and taking that uncomfortable roller coaster ride down the bear market. And if you're like me, you've worked hard. You've invested your time and your money, and you've taken that long walk up the stairs that bull markets do. And just because you've taken that long walk up, that doesn't require or obligate you to take that rapid falling bear market ride down. We spent all this time waiting to get to the top. I feel like we should stop and enjoy the top for a little while and take that as an opportunity to lock in profits. This is why I will absolutely sell my gold and silver. This is why I shake my head when people pound their chest and say, I will never sell. I'm leaving it to my children. Well, I plan to leave it to my children as well. The difference is I'd rather leave more. And so my ability, your ability to understand the cycles, understand the psychology of investors and investments will allow you to better prepare yourself and establish an exit strategy. It kind of makes me wonder and ask the question out loud, where did precious metal investors forget the fundamental principle of investing, which is we're supposed to buy low and sell high? So as we start to wrap this up, please share in the comments your response to any of these following questions. Will you ever sell your precious metals? Why or why not? If yes, when will you sell? Is it going to be based on a dollar amount, a percentage gain? Why? It's more important that you think about your exit strategy before we get to the top. It should inform your purchasing decisions. It should inform how much you buy, what size you buy. Do you stick to coins and sovereign, or do you go with generics and bars? What? So I hope that you take this information and use it as an opportunity to think about what is your exit strategy. And if you truly believe fundamentally that you should never ever sell, more power to you. I want you to get every ounce that you can get your hands on. And so I just asked you to respond in the comments to some of those questions. And if I can ask you to do one more thing, can you hit the like button and the subscribe so that Stackers University can get out to more people? It sure will make the biggest difference in the world. Plus, I don't want you to miss any upcoming videos. That would be greatly appreciated. And finally, as we always end, always stack smarter and never stop learning.